So much about capitalism. Now we come to something that is important for capitalism, but that was there long before capitalism, and this is money. So what is money? Here we have the very elegant definition to say that money is whatever fulfills the functions of money. And what are the functions of money? First, we have money as a medium of exchange. This is something that O'Brien and Williams described at length in the textbook. Let's say you are a strawberry farmer and you want a telephone. And let's also say that your harvest was big enough that you can easily afford a telephone because your strawberries are worth a lot of telephones. However, you will probably have a problem finding a telephone dealer that will be willing to exchange his telephone for so many strawberries as a telephone is worth, because they don't need that many strawberries. Then you can say, well, what do you need, telephone dealer? And he says, I could use some strawberries, I could also use some carrots, some apples, and a little bit of steel. So then you try to find people who give you carrots and steel and apples for your strawberries, and then you gather all that stuff, and then you go back to the telephone dealer, and then you will trade all this stuff for the telephone, and this is obviously not very efficient. So it would be very convenient if there was one medium of exchange that everybody uses to exchange their strawberries, apples, telephones, steel, and so on. And this is one of the functions of money, that you have one thing that does this for everything. And obviously that should be something that is very small and quite valuable still, so you want to put a lot of value into your pocket. And it also should be quite durable, because if you use strawberry, for example, they would go bad after 2 weeks, and that would not be a very good medium of exchange. The second function of money is as a measure of value or a unit of account. Take the example that I just mentioned before. You possibly could say, well, one smartphone is worth, 50,000 strawberries. And then you have a relation between phones and strawberries. And then you can say, well, one apple is worth 5 strawberries. And then you know also that a telephone is worth 10,000 apples. And if you want to make these kinds of deals, then it becomes very complicated, because then the telephone dealer has to have a very long price tag on his telephone detailing how many apples, strawberries, meters of steel, or whatever this telephone is worth. And this is obviously also something that's not working. The same goes for your bank account. If your bank account was given in apples, strawberries, steel, and telephones, that would also not be very convenient. So you probably would want to have one measure for value and one unit of account. And once again, it would be very helpful if this was something that was easily counted and universally exchangeable. Next thing, third function, is money as a store of value. It's particularly important for strawberry farmers, because the harvest season for strawberries is rather short in spring, and after that they wouldn't have any income if all they did was strawberry farming. And you cannot really keep strawberries for 11 months so that you can buy strawberries all the time, because they go bad quite quickly. So what you want as a strawberry farmer is having some commodity in which you can store the value of your strawberries, so that you will be able to buy stuff also still in December and January, when the strawberry harvest is long gone. And once again, this should be something that is durable and exchangeable. And finally, and here this is not always part of the functions of money. Some say there are 3 functions of money. Some say there are 4 functions of money. The fourth function is the unit of deferred payment, and this is basically about credit. So if you take a credit, you have to give a unit in which this credit is given. So if you borrow 3 euros to buy a coffee, you can either say, well, I owe you a coffee, or you can say, I owe you 3 euros. And so when the person that you borrowed the money from at some point says, well, I want my loan back, then you can either repay him in coffee or you can repay him in euros. And typically, most people would prefer to have something that is universally exchangeable there, so that you have a unit in which you can give this credit, and this is better euros than coffee. Then some argue that this is already part of some things that I said before and it's not a function of its own, but some argue it is a function of its own. So what kind of stuff could fulfill these functions of money? Typically you distinguish two kinds of money. The first is commodity money. In a system based on commodity money, one commodity routinely fulfills the function of money. It could also be more than one commodity, but it shouldn't be too many because, again, then you would need very long price tags. And what kind of commodities could be used for this? There are a couple of criteria that these commodities would have to meet. So first is they should be durable. You don't want to use strawberries or apples or carrots because they will go bad after a couple of days or weeks or months, and so they won't work very well as a store of value, but you want something that keeps its value over years, ideally. Secondly, you want something that's probably quite valuable even in small physical amounts. So if you want to go shopping, you don't want to carry a whole bag of money commodity to the store. It's better if the money fits in your wallet, and this is even more important if you are a merchant traveling on a merchant ship, because then you probably want your ship full of goods and not an extra ship full of a money commodity. And then something that's also important that you might not think of at first glance is also that the money commodity has to be scarce, but it also has to be available. So if you use something like stones, it won't work because there are too many stones out there and everybody could just go somewhere and pick up a couple of stones and then use them as money. So it won't work because it's not scarce enough. If, however, you use something that's very, very, very scarce as your money commodity, then there just won't be enough of it to keep your economy going. So you need something that is kind of scarce, but that's also sufficiently available. And if you find commodities that fulfill these conditions, then you can use them as a money commodity or commodity money. What was typically used for long stretches of human history were either metals like gold and silver, or at some regions also seashells. And the big advantage of commodity money is that the value is inherent to them as a commodity, so you don't have to really trust anybody because you know this gold is so valuable and it takes a lot of effort and luck to get some gold, and so you say, well, this is valuable and it will probably stay valuable because it's a commodity. So you think of it this way, and then you don't have to trust the person that's making the coin out of the gold, because the gold itself is valuable and the coin is just a way of slicing the gold, so to speak. So it's the value in the commodity that you trust in. The alternative to it, and this is what of course we all use every day, is fiat money. And fiat means basically, let's do it. So fiat money is something that is simply done and then used. First it was done by banks issuing pieces of paper saying, this and this person gave me so much gold, and this paper certifies that we have this gold here, and you can exchange this piece of paper for this gold anytime you want. So if you don't want to go around carrying all that gold, you just bring your gold to a bank. The bank will give you a piece of paper, and then if you want to buy something, you can hand on this piece of paper, and whoever you buy your stuff from will have this piece of paper, can go to the bank and get their gold worth for it. And of course this is somewhat more convenient. However, it's also a little bit more dangerous because here you have a whole different kind of problem with counterfeiting money, and you also have to trust the institution issuing the piece of paper that they will actually keep the money and keep the gold and actually exchange the paper for gold. Because if you are a not trustworthy banker, you could just take the gold, issue those pieces of paper, and then take off with the gold. And if you have the suspicion that the banker will do that, you will probably not accept their pieces of paper. And this kind of paper money, I'm sorry to repeat this again, it's something that China had before Europe had it, but you have these kind of banks issuing money in the northern Italian city-states already before 1400, so it's kind of special there. But today, of course, these banknotes are typically not handed out by individual business banks. They are handed out by the central banks, which is basically by the state. So nowadays, you don't trust the money because you trust a certain bank. You trust the money because you trust the government that will issue this piece of money. Last point here is that for the government, this of course has another advantage also, because if you issue commodity money, then you have to buy the gold first, then you have to make this money into coins, and then you issue the coins, and then you actually have to add some extra labor in making these coins, and they're still only worth the amount of gold that they're made of. If, however, you create money from paper, then the production cost of the money will be much lower than the value of the money that you hand out, and this is what we call seigniorage. So in this type of fiat money system, states by issuing money can also kind of make money. Next, we talk about banks. So what is banking and what is a bank? A bank is an institution or a business that does not produce anything, but rather they offer services. And the services they offer are financial services, which meaning services having to do with money. The two most important services banks offer are accepting deposits and granting credits. Accepting deposit means if you have money and you don't want to carry it around in your wallet all the time, you don't want to store it under your pillow, you can carry it to the bank, give it to them, and then they will store it for you and certify that they have your money. Granting credits means that if you need money and you don't have it at the moment, so you have to buy something, but you're not liquid right now, then you can go to the bank and say, well, I need this and this, and you can trust me for these reasons, so please give me some money. I will give them back to you at some point with some interest, and if they think you are trustworthy, then they will give you that money. And this is true for individuals and for businesses, of course. But banking is, of course, not limited to these two services. You could also think of other services. I will discuss them later. What's important to note here is that banks are not storage facilities for monies. So once again, this is not Scrooge McDuck's money bin. Typically, banks only have a very small fraction of the money that is deposited at them available there, because in order to have their business run, they cannot just store the money, they have to use the money again there. So it's not that they have one department in the bank which is deposits, where they just store the money of people, and they have another department which is giving credits, where they have a lot of money they just had to begin with and then just give this out in pieces. Rather, they have a big pool of all the money, all the deposits coming in, and the credits they give, they take from the deposits they have. And this, of course, is somewhat risky, because it means if 1,000 of people have deposited money in a bank and all of them have deposited $1,000, then the bank will have a total deposit of $1 million. Then, however, the bank gave out I don't know, maybe $500,000, $600,000 in credits from these millions of dollars. And now if all the 1,000 people say, well, I need my $1,000 right now, can you give it to me? Then the bank won't be able to pay all of them. And this sounds like a problem, but typically in everyday life, it's not a problem because not everybody would want to call their deposit at the same time. However, it can become a problem when there is what we call a bank run, and bank run is exactly this: everybody going to the bank and wanting their deposits back. And when will this happen? It will happen when the people have some reason to doubt in the bank. And here begins the real danger, because as soon as people believe they have reasons to have doubt in the bank, a bank run dynamic might emerge, and then people actually do have a good reason to have doubts in the bank, because when there is a bank run, they won't be able to get the money. This is kind of similar to the dynamics that we saw with the hoarding at the beginning of the coronavirus crisis, which happened with different commodities in different countries. In Germany, it was mainly toilet paper, also some other stuff. I don't know what it says about Germans that it was about toilet paper, but it was about toilet paper. So the story is that there was always enough toilet paper produced for everyone. However, if every person goes to the store and buys one extra package of toilet paper, one package more than they would normally buy, then there won't be enough toilet paper in the stores, and then people actually have a good reason to try to get toilet paper really badly, because they really can't be sure whether it would be there the next day. So if nobody would have been hoarding, there would probably have been no shortage in toilet paper. But because people believed there was a danger of shortage, an actual shortage emerged. And something similar happens with a bank run. And this is why banking is a risky business, and this can then also lead to wider dynamics, because the banks also give each other credits, and if there's a bank run on one bank, then the other banks might have problems because they have credits at this bank, and then they won't get their money back, and then the trust in the second bank might also be in doubt, and then there might be a whole dynamic of bank runs, and then the banking system will collapse. And without a banking system, capitalism will not work. So this is a very vulnerable point in capitalist economy, which is why it is regulated. I was going to say heavily regulated, but unfortunately it's not always that heavily regulated. What regulation, for example, does is demanding that banks always keep a certain amount of cash at hand, so they're not allowed to give out all their deposits that they have as credits, and they're also maybe required to have a certain amount of capital of their own, so that they do not only give out credits based on deposits that they take, and some more regulations apply there, so the state tries to reduce this danger. And moreover, what the state can do is say, we act as the lender of last resort, so if there will be a bank run, we will guarantee that all bank customers will get their money back. And if the state says this, and the people who might not trust this individual bank, they still trust the state that they will have enough money to pay them, then there might not be a bank run. So if the state acts as a lender of last resort and promises to act as a lender of last resort, it's quite likely that they in the end don't have to act as a lender of last resort, because just the promise makes the bank run stop in the best case. So what kinds of banks are there? In the textbook, O'Brien and Williams distinguish three kinds of banks. You could easily make the case that there are not three, but 4 or 5 kinds of banks, or you could say, well, these 3 types are only 2 types in reality. However, I don't want to create any more confusion, and I will stick with the 3 types the textbook names. The first type of bank O'Brien and Williams name are what we would call commercial banks or deposit banks. These banks do pretty much what I described before, so they offer these basic financial services like taking deposits or giving loans to private customers, which are people like you and me, or to businesses, which could also be people like you and me, but could also be bigger businesses that are not really individual people. And you can then distinguish these things and say, well, the private customer, that's retail banking, and the businesses, only that's real commercial banking. But in general, that's what commercial banks or deposit banks do. And this is very, very important for capitalism to work. As an individual now, you might think, well, having banks is convenient, but it's not really necessary, because no, it's better to have the money in a bank instead of carrying it around all the time or having it under your pillow. It's better to have online banking and bank transfers than paying everything in cash, but it could possibly still work otherwise. If, however, you look at it from a systemic perspective, for capitalism, we cannot do without banks. Capitalism would not work without banks. One thing is that businesses oftentimes need loans to make the investments they have to make in order to produce at a competitive price. This is still something where you might argue we don't really need this, but there's a bigger systemic issue, that is that too many people saving money under the pillow would really destroy capitalism. Because for capitalism to work, the money must always circulate and people must always buy stuff. So if people just save money under the pillow, it's bad. And to some extent, you want people to save money, because if they don't save money, they would be bankrupt as soon as they lose their jobs, maybe, or meet some other kind of economic hardship. If they don't save money, they wouldn't ever be able to buy a car or a television set or a washing machine or any other kind of expensive stuff that you cannot just buy with the money that you earn each day. So you want them to save money. But if millions of people save thousands of euros each, then all this money is not being spent. And this means that businesses cannot sell their goods and services, and this feeds into the kind of capitalist demand crisis that I just sketched before. So if instead we have some banks where people put their money to save it, and then these banks give that money back out to other people who then take credits and to use their credits to then spend money, then this is much better for capitalism, and probably without capitalism could simply not exist. However, capitalism is not necessary for banking to work, so there was banking before capitalism, but there can hardly be capitalism without banking. The second type of banks that the textbook names is what we call investment banks or merchant banks, and these banks are not there for individual customers. They're not there for small businesses getting loans or depositing their money or making their payments. They are there for activities in the financial markets. One of these activities businesses might need them for is when a business will issue stocks. So if a business wants to have more capital for investment, they might ask a bank for a loan. However, they might also decide to go to the stock exchange and issue stocks, which basically means kind of selling parts of their company to those people who then buy the stocks. And this process is something that you need experts to do it, and this is something that investment banks offer for businesses who want to issue stocks. And this is what we call the primary market of stocks, is the market in which initially issued stocks are traded. And after that, you can also buy stocks of companies that already have them out there, and then you don't buy them from the company directly, you buy them from others who already hold those stocks. Then there are also other activities in the financial markets that these banks organize for companies. So there might be mergers or acquisitions. So it might be that two companies fuse together or one company take over another company. Then they might also engage in asset management, which they would not do for you as an individual, but they would do for, let's say, a pension fund or so. So some institution which has a great amount of money, and then these assets which are in the hundreds of millions or billions of dollars when they have to be managed. So these are things investment banks organize. And there is, of course, no natural distinction between commercial banks and investment banks. It is no natural law that these kinds of activities are pursued by different kinds of banks. Actually, this distinction comes from the year 1933, when there was a new law on regulating banks in the United States, and this separated investment banking from deposit banking. So if you were to engage in investment banking, you were not allowed to engage in deposit banking at the same time, in order to safeguard deposit banking from the rather risky venture of investment banks. However, this distinction, which was made in 1933, kind of collapsed in the Great Recession, in the banking crisis of 2008, 2009, 2010, because then the big investment banks in New York, most of them failed. So some of them, like Lehman Brothers, just went bankrupt, and others were then bought by bigger banks like Citigroup or other bigger banks, and yet other investment banks were already bought by big commercial banks beforehand. So since the 1990s, many big international banks, also German banks like Deutsche Bank or Dresdner Bank, Commerzbank, they engaged in buying investment banks in New York because this was supposedly a very profitable business. So they wanted to expand their activities to incorporate these kind of activities also. Then a big crisis in investment banking happened, and now there aren't really pure investment banks as opposed to commercial banks anymore. However, I don't want to say that this distinction is senseless. We should still very much distinguish the activities. So we should distinguish commercial banking from investment banking, even if they are not always institutionally separated anymore. Something that is institutionally separated still is central banking or reserve banking, and these are the government agencies that I already mentioned when discussing fiat money. They are the agencies that will issue this money, and also they have other things to do. They don't only issue money, they also manage the currency, means the relation of the money of one country to the money of other countries. This is something that I will discuss more in the coming weeks, the international monetary system. I didn't have the time today, I will go into this later. And something that you will oftentimes hear in the news from central banking is that they control the interest rates, which is the rate at which investment banks or commercial banks can lend money from the central bank, and thereby they manage the money supply in a society. And I will go into this more at a later stage of the lecture. And something that finally central banks also sometimes do, sometimes there are other agencies who do this, is bank oversight. So what I just described, enforcing the banking regulations and seeing whether the banking system is stable, can also be a task of the central bank.